The trade fight and today's May jobs report are definitely on the minds of what looks to be an increasingly dovish Fed, and they're gearing up for their next policy meeting, now less than 2 weeks away. Yahoo Finance's Cheung is here with more. So, Brian, how do you think the numbers this morning change the calculation, if at all, for the Fed?
Well, it really depends on whether or not you think the numbers released this morning are more telling for full employment than the previous numbers that we received in the earlier parts of this year. Keep in mind that the Federal Reserve has said that inflation has been the missing piece of the puzzle, and that some policymakers actually saw the economy as pretty close to full employment. I had the chance to chat with Lael Brainard. She is the governor at the Federal Reserve, who actually told me that she doesn't want to pay too much attention to any single number. At the time I asked her about the low ADP reading that we saw on Wednesday, she said that she would be more interested in seeing what the results of today's report would say. So obviously Fed makers paying very close attention to this jobs report. It is the last jobs report that we'll see before, as you mentioned, the next Fed meeting takes place on June 19.
Brian, if the Fed is data dependent, which they have pounded into our heads the past year and a half, doesn't this type of job report suggest that, yes, a rate cut could happen at the next meeting?
It could, and that's partially because the fact that we see the unemployment rate staying the same in addition to the labor force participation rate, despite the fact that the non-farm payrolls actually were quite below estimates. Now, it's interesting to pay attention to wages, as that has been the big piece of the puzzle, as I mentioned, for the current Fed policy-making decisions. As we know, inflation has fallen pretty below its 2% target range. The most recent reading of core personal consumption expenditures was 1.6, and some say that if you see higher wages, that could create inflationary pressures that would actually be the case for a rate cut. But as you see, average hourly earnings went up by only 3.1%. That is lower than some of the readings that we saw. The hottest reading that we saw as of late was 3.4% in February. So this is not showing any sort of inflationary pressures at all. So if you are watching hourly wages, you might say that this does indeed increase the case for a rate cut.
Well, with inflation off the table for now, for the foreseeable future, Brian, aren't the tariffs then ultimately the most immediate threat to the economy, at least in the Fed's eyes? Absolutely.
So when you think about the fact that there are two components to inflation, one being what we see in the labor market with how much workers are paid, how much people pay for goods is the other part of it. And obviously that would increase if we see those tariffs ratchet up in Mexico, and in addition to the effects that we've already seen from the 25% tariffs in China. So policymakers paying very close attention to those numbers.